A few days ago, markets were rattled by another tariff threat from Donald Trump. Futures sold off. Volatility spiked. Crypto bled first. Headlines warned of escalating geopolitical risk and a new transatlantic trade war tied to Greenland. And as usual, most commentary focused on what tariffs might do to the economy months from now. That missed the point, because once again, tariffs did not change fundamentals overnight. They changed positioning. Before we go further, make sure you subscribe to the channel and turn on notifications so you never miss these real-time breakdowns. And if you want to be positioned before these moves unfold, use the link below in the description to join us inside Market Traders Daily Premium. The next opportunity won't wait for headlines to catch up. And that difference is exactly why the market behaved the way it did and why the opportunity appeared when it did. The core idea behind the 72-hour window is simple. When tariff threats hit the tape, markets do not reprice earnings or balance sheets first. They reprice uncertainty. Uncertainty forces risk systems to act. Volatility targeting strategies reduce exposure. Risk parity models cut equity risk. Leverage comes down. Liquidity thins. That first move often looks emotional or irrational, but it is mostly mechanical. Prices fall faster than fundamentals change. That creates a temporary gap, and inside that gap is where disciplined investors operate. On January 17th, President Trump announced a 10% tariff on goods from 8 European countries, set to begin February 1st, with a threat to raise tariffs to 25% by June if a broader deal around Greenland was not reached. The announcement came over the weekend. Markets did exactly what they usually do when uncertainty is injected suddenly and price discovery is delayed. By the time cash markets reopened, U.S. equities sold off sharply. European markets followed. Volatility spiked. Risk assets were hit indiscriminately. Nothing about earnings changed between Friday and Tuesday. Positioning did. Phase 1 played out in real time. The initial sell-off was a textbook example of Phase 1 in the tariff cycle. It was fast, broad, and mechanical. The S&P 500 dropped more than 2% on January 20th. The Nasdaq fell even harder. European indices slid in tandem. Crypto absorbed pressure immediately, as it tends to do during global risk resets. This was not a verdict on long-term growth. It was capital reacting to uncertainty. And importantly, it happened quickly. As outlined in the original framework, Phase 1 rarely lasts long once forced sellers have acted. Within days, headlines shifted. European leaders condemned the move, emergency meetings were held, and language moved away from escalation toward process. The focus turned to negotiations, frameworks, and avoiding a broader trade war. Volatility peaked, selling pressure slowed. Then came Phase 3. On January 21st, during and after remarks at the World Economic Forum, Trump ruled out the use of force in Greenland and announced a framework of a future deal on Arctic security after meeting with NATO leadership. Crucially, the February 1st tariffs were taken off the table. Uncertainty collapsed. Markets responded immediately. U.S. equities rallied sharply. European stocks recovered a large portion of their losses. Volatility compressed almost as fast as it had expanded. Not because everything was suddenly fixed, but because unknowns became known. This episode followed the exact structure outlined in the 72-hour window. Phase 1, mechanical flush driven by uncertainty and risk controls. Phase 2, narrative shift toward negotiation and process. Phase 3, resolution that collapses uncertainty and forces a recalibration. The entire cycle played out in under a week. That compressed timeline is not a coincidence. Modern markets amplify uncertainty faster than they absorb information. And that is precisely why positioning matters more than opinions in the early stages. For premium members, this was not just an observation, it was a trade setup. As the market sold off into Phase 1, we outlined specific SPY-based levels where risk could be reintroduced with discipline. One of those vehicles was UPRO. Entries in the 112 to 114 zone provided a clear framework. exposure added during forced selling, a defined cushion as volatility stabilized.
Upside participation once uncertainty collapsed.
When the tariff cycle moved into the relief stage, the lift was almost immediate. That is not because the trade predicted Trump's decision. It is because it respected how markets behave when positioning resets. The takeaway here is not that every tariff threat will reverse quickly. Sometimes they escalate, sometimes they drag on, sometimes they evolve into real economic repricing. The lesson is this: markets consistently overshoot during the uncertainty phase because capital is forced to act before information settles. That overshoot creates opportunity for those who distinguish between volatility-driven flushes
and genuine fundamental deterioration.
This episode was the former. Some commentators labeled this outcome "Trump always chickens out." That framing misses the structural insight. Whether tariffs stick or not, the process creates repeatable market behavior. Tariff threats inject uncertainty. Uncertainty forces positioning resets. Positioning resets create dislocations. Those dislocations are tradable if you understand the cycle. This was not a lucky call. It was a framework playing out in real time. Tariffs didn't change the economy in a weekend. They changed positioning. And once that positioning reset was complete, markets did what they almost always do next. The 72-hour window closed. Until the next time uncertainty forces it open again. And if you want to be positioned during that next window instead of reacting after the fact, make sure you subscribe to this channel and turn on notifications. Our premium members are positioned while uncertainty is still being priced. Inside Market Traders Daily Premium, you get real-time trade setups built around positioning, volatility, and risk structure. Clear entry zones and sizing guidance, not vague opinions. Insider alerts highlighting unusual insider buying and accumulation patterns. Context around macro shocks like tariffs, policy pivots, and geopolitical headlines, and how to trade them. Ongoing updates as conditions change, so you're not guessing alone. This tariff cycle wasn't about predicting headlines. It was about understanding how markets behave when leverage is forced out, and having a plan ready when it happens. If you want access to the next setup before the relief stage begins, use the link below in the description to join Market Traders Daily Premium.